Good morning, ladies and gentlemen. As always, we start with a review of what's been going on in the bond market. And as you can see, this week we've had a very interesting week, and we are just above the 200-day moving average in the 5-year notes. The Fed put has more or less done its job. The Fed has told you that they are beginning to wind down on the rate hikes, and the market has responded basically by taking yields to the 200-day moving average. What is going to happen here? Well, more likely than not, we are going to trade just above the 200-day moving average, and at some stage we are going to piss through it and come back down probably to the 270 yield area. Much the same pattern in the 10-year notes. This is we are about 7-8 basis points away from the 200-day moving average. The Bollinger Bands are opening nicely. There will be counter trend reactions towards 3 or just above, and then the market at some stage is definitely going to break down and through the 200-day moving average. What is actually noticeable is that for the first time in a long time, we have actually closed ever so slightly through 115.25 in the TLT, giving us room to rally now towards 117 and 118, consolidate, and then make the next move. To me, that is very indicative of a market which is not going to go down anymore, but one which will range trade at worst, and then probably at some stage when the economy is weak enough is going to bust through the 200-day moving average and go significantly higher. But that is for next year, that is not for now. It is certainly something which will indicate a pickup in volatility in the future. I don't think December is the month. I don't think we have enough evidence of a weak economy. We have the Fed jawboning things all right. At some stage there will be increased volatility in bonds. Certainly I would expect towards the end of the first quarter of next year, but now is not the timing. Now is the timing to basically park your money in 2s and 5s and enjoy. Much the same thing in bunds. This is a weekly yield chart in bunds. You can see how we are at very important levels that we've always stopped at in the past. Here we are at around 30 basis points. The market just doesn't care about anything that says the economy is just fragile. Even though we are probably going to get the end of QE this month from the ECB, the market just doesn't care. There's just no impetus to the upside. You see the Bollinger Bands are flat. We are trading in a 15-20 basis point range, and that is all there is to it, which actually makes the spread. This is Germany to the US. It's coming in slightly, and that to me argues that the dollar is not going to ramp in the month of December. It's going to stay firmish, but it's not going to ramp. It's quite simple that you have yields contracting between Germany and the US, and therefore the impetus for a much higher dollar is definitely restrained. The DX is doing exactly what we think it would do. It's slowly meandering up. It is using 96.50 as a very good support, and then the moving averages are turning upwards and so on, and at some stage over the course of the next few weeks we will get to 99 objective. From there on, I would have thought the year is over. The market will be in a position to then make a significant move from that 99 level next year. But we don't need to think about it at the moment. We can just see that the market is slowly meandering towards a stronger dollar, and that's basically all there is to it. My own focus in in foreign exchange is next week going to actually shift to the pound, simply because on the 11th of December we have the vote in the House of Commons on Brexit, which everybody assumes is going to fail. Yeah, okay, probably will, but I think that the danger actually is that it doesn't fail, that it passes, because we are discounting a fail. Okay, so if we get a confirmed fail, we might get down towards the 121 level. But if we don't, we are more likely than not to see 135. And we will be exploring on the Twitter some exciting option plays that we can do, basically free ones if we can, or ones that cost very little money, because sterling to me is very cheap. It's naturally cheap for a reason, because the market is discounting the worst of all possible worlds, which could easily materialize. But I think the dangers, as always, are in the direction that nobody's looking at, and that direction is up towards 135. Before we start the review of equities, we have to look at where the risk dial is, and it's -39. Okay, so if you look here, it was -37 on Thursday, and it's -39 on Friday, i.e. it got worse. It means that the spreads are deteriorating, the internals of the market are deteriorating. It just doesn't give a damn about the higher prices in the SPX. This we have to keep in the back of our mind, because this is never wrong. It cannot be wrong. It's just a statement of fact. Where are the spreads? There is no way this market makes a strong move to the upside without the spreads being in positive territory. It is impossible, mathematically impossible, and therefore that has to color our view about what is about to happen. Last week was a very good week for us, but also one probably of the easiest calls that we had to make all year. If you look at, this is a weekly chart of SPX, we closed below the Bollinger Bands, we had so many events coming up, everybody was so bearish that the obvious play was to go back up to the into the range of the 27-25 plus, which is exactly what we got. Everybody got squeezed out of their short positions, and now they're chasing with a whole load of FOMO. Okay, fine. They were wrong on the downside, they will probably be wrong on the upside. Until and when the market closes with a strong bias above this red line, which is 27.72, I really don't see that we are anywhere in any different position that we have been ever since we broke it, and that was in early October. All we've done since early October is basically go sideways and stop everybody out every which way. So having said that, and having taken into consideration that the spreads are just as negative now as they were when we broke here, if not more so, let us see on the dailies what we are likely to do over the course of the next week. First of all, the hourly chart of SPX. This is just US time, and as we can see, it just slingshot higher because everybody was short, everybody was short, everybody was short. Oops, pow, boom, and then everybody started chasing. Is the chasing warranted? No, I don't think it is. What is warranted, and what is almost certain to happen, is you can see there's a gap here at 27.80. That's going to get filled. There's another gap here, 27.99, 2800. That's going to get filled. unless we get something amazingly bearish out of the G20 over the course of the weekend, at some stage over the course of the next week, we're going to go and fill those gaps for sure. We will probably even take out the 28.15 level because there must be a whole load of stops there. So to me, unless you get a bearish outcome from the US, which is from the G20, which is unlikely in my expectations, we are going to go and fill those gaps, stop everybody out, and then we will just turn on a sixpence and come back down. Why do I think that? Well, because the technicals and the fundamentals are actually now aligning, and let's have a look at that. And here we have the fundamentals. So the Blue Angels forward earnings between 15 and 16, that's what I said is where we trade, and that is what we're trading. They are slowly turning, aren't they? Turning down. So we're still stuck for all intents and purposes between the 2800, 2810 and the 2625, 2600 area. There is absolutely no reason why this market should go any higher. It can certainly take out the highs by a few ticks, get everybody long, and then come back down into the range. This actually is beginning to be very reminiscent of this, is it not? Or this, or this. We are basically in the 2014-2015 area. We're having a bit of a slowdown in the market as the Fed does what it does and reassures the market. They take it back up to the higher Bollinger Band, but it's just unsustainable because the fundamentals do not support any higher prices than that. To me, that is pretty obvious at the moment, and unless things change, I'm not going to change my mind. So having seen the fundamentals, let's go back to a daily. And here we have the obvious. The obvious is that we are about to get a death cross in the 200 against the 50-day, but, you know, so who cares? We have the momentum, which is decidedly up. We had the very obvious here divergence in the RSI, which made this quite an easy call. And now, you know, as I said, 28.17, 28.20, that's where we are going to go. Take everybody out, make everybody bullish. Oh, Santa Claus is coming to town, and then not. Quite an obvious setup. Get everybody long, and then basically pull the rug. So we can definitely play it long up to the gap fills and the stops above 28.10. If, you know, 28.61, 63 to me is the absolute level that would be a gift. If we see 28.61, I'm going to get so long of puts. It's just not true. As simple as that. That is what I see. I see a market which is basically going between the 15-day, the times 15 Blue Angel and the times 16 Blue Angel, exceeding it on both sides by 0.5% just to get people very bullish or very bearish, and then reverses back into the range. To me, this market is a 27.25 market, 27.25 trades. That is what I think is more likely than not to keep on happening over the course of December. Now please compare and contrast this chart, which is daily NQ, to the one that I've just shown you, the SPX. These highs here keep on being lower highs, while in the S&Ps they are almost flat highs. That basically means is that there is no leadership out of technology. In fact, technology is deteriorating while the SPX is actually holding flat. To me, that means that the internals are shot. High beta is still for sale. Until this picture changes, there is zero chance that S&Ps are going to make a break for the highs. And if you actually have a look at YMI, the Dow, these highs are actually higher highs. So the Dow is the one which has the potential now to trade up to 26,300 plus, i.e. within a whisker of the all-time highs. What does the Dow outperforming SPX, outperforming NQ tell you? It just tells you that the market has no leadership. People are going into safety and keep on going into safety. That is not what huge rallies are made out of. That's a defensive play, even at levels which should not be defensive. There is no way the market should be defensive up here, is there? And yet it is. The spreads indicate it. It's quite obvious by looking at a chart that, you know, NQ is outperforming SPX, and SPX is the Dow is outperforming SPX, and SPX is outperforming NQ. How is that going to give us a huge rally? It just not. This is a range trade with people shifting money out of high beta when the opportunity arises into something safer. Not a very bullish scenario as far as I'm concerned. Weekly chart of the DAX. Okay, and the amazing thing is that while the US rallied, what was it? I don't know, nearly 5%. The DAX closed negative. And that is what I keep on telling you. Europe, there's something very, very badly wrong with it. I don't know what it is. You know, some people say it's Deutsche Bank, some people say it's Italy, it's this or that. I don't know. It's probably a bit of everything. But to me, Europe is just to be avoided. If you compare and contrast, I mean, if you want to be long of something, it's much better to be long of Nikkei, isn't it? You know, Nikkei at least is making a decent lowish pattern, isn't it? It isn't as outright bearish as Europe. To me, you want to be long of something like Dow and Nikkei, and you want to be short of high beta, and you want to be short of Europe. It's a position I've held for weeks and weeks and weeks, and I have no reason to change it because the P&L is telling me I'm right. Well, last week VIX told us all we needed to know about the market. It was bullish. He was saying SPX up all week, and that is exactly what we got. Right, so what are we likely to have? We are likely to come down to at least the 1630 level. And very early on next week, and that would argue for a quick move up to the 2800, 2810 area in the S&Ps, and from then on we are going to find it very, very difficult to go any further than that. That's why I've put down 1630s where I want to be long of volatility. If we enlarge this, we see that we have some gaps down here. Fill those gaps, bounce off the 1625, 1630 and go back up towards 1850, which basically aligns with my view that we go up, fill those gaps above around 2800, maybe get people all bullsed up, stopped out or whatever, and then we turn. When deciding on pretty large positioning, I always like to have a look at the transports to confirm or deny my view. Pressed the wrong button. Last week they definitely were confirming, and I was quite happy being long. Now we have the situation. You can see why, because this is where we were in the S&Ps down here, while the transports never, ever, ever went down. So, to me, that is quite obvious that we slowly go up towards the 11,150 area, and probably there we fail. So still happy to play the upside in SPX, but with a huge note of caution once we get to 11,150 in the transports. Okay, just as confirmation of what I've told you a while back about Japan and Europe. This is EWG, so Germany over Japan. Broom. Very ugly chart. I mean, very, very ugly chart. This goes all the way back to 09. It is, I mean, I don't know what is wrong with Europe and what is happening, but there's something definitely wrong under the hood. Okay, somebody will say, well, it's coming down to here, which is only a couple of percentage points away, or it's coming down to here, or whatever. But to me, this is just a bleh. It's just a giant decade-long puke out. I'm just saying, I mean, I invest for myself, so I've got 10, 20, 30-year time horizons, and I can just stick with positions. But to me, I mean, I've shifted out of Europe completely, because to me, this is just so ugly. There's nothing bullish about Europe. It's bad against everything you look. So that is all I have to say. I just wanted to show you this chart because to me it just very symptomatic that something very ugly is happening, and these are very long-term moving averages. You know, every time it rallies, I just sell it, and you know, the P&L just telling me I'm right. I just thought, you know, you might be interested in this. So what are the biases for next week? Well, we are at 115.25 in TLT. As I said, there will be now volatility in bonds next year. I don't think we're going to have a huge amount of volatility in December. There's no reason for it. But now you want to be a buyer of dips in futures, i.e. a seller of yields on spikes. Bunds and bobble, I mean, you know, this is not changing. It just, we've been here for weeks and weeks and weeks. You just can't trade them because they're making no fundamental sense, and that is because the ECB basically owns them all. How are you going to fight the ECB? Well, you and I are just not big enough to do that. I mean, I don't think anybody is big enough to do that, and therefore just leave them alone. That's all there is to it. SPX, you know, no change. 15 times Blue Angel, that's 26, 25. 16 times Blue Angel, 2800. And 2861 is the level for buying puts. That, you know, we will do until the cows come home. NQ is, as I showed you in those charts, is looking increasingly vulnerable and has lost all leadership. One day when SPX turns, actually you'll see NQ turning much faster, as always. VX, buy the dip at 1630. 1630 is the level. 24 is the absolute maximum at the moment, and only closes above 21 indicate any danger of the market having a very nasty day. You know, anything up towards 2021 is all right. It just means the market is scared that day for whatever reason. Any closes above 21 and I start getting worried. But 1630 is when I want to make a bit of a stand and get longer volatility. I mean, European equities, I've showed you all there is to it. I mean, if by any chance DAX gets up to 11,800, I don't know what it would take for the other markets to do, for the DAX to do that. You just want to buy, you know, a whole load of put spreads. The dollar keeps on holding that 96.50 area, and while it does, it should go up towards 99. That's our target. It has been for weeks. Please stay long of high quality against high beta. Down Nikkei. Do not be overweight of this stuff. Be overweight of this stuff. That is what the best evidence is, and that is what you should be doing. Thank you very much indeed, and tweet you next week.